Hello and welcome back to Moneycontrol's live stream. You're tuned into Closing Bell with me, Lovisha, Darad, and with me joining my colleague Nandita Khemka. Nandita, once again, a very quiet and a very choppy trade that we saw. Of course, we are in a consolidation zone and the market is in search for triggers for any further up move. The two major triggers remaining, of course, that is your earnings season, where we have been seeing a first quarter updates which has been flowing in, and the second, that is your paramount watch, that is your India-US trade deal. But if you look at from the levels front, Sensex and Nifty, both of them have ended flat but with a positive bias. However, the breadth of the markets that continue to lean towards the declines. Sectorally, if we see FMCG index, that was the top performer of the day. Nifty FMCG, which ended with about 1% gains or so, given the good updates we've been getting from Darad, Godrej Consumer, Marico. We did see a sequential recovery in all of them in terms of volumes, and some recovery in terms of urban demand trends was also visible, which also led to an uptick in some of the FMCG stocks. However, on the flip side, Bank Nifty that continues to remain muted, and Realty and metal stocks continue to lose sheen. Now, another wait and watch session that we saw today once again.
Lovisha, there's only one way to sum up today's market action. Although you mentioned that we've seen a phase of consolidation, but today's action, to say the least, seemed like a snooze fest, so to say. If you look at the screens, right, just an 80-point range, and the Nifty was moving in that range, and really nothing to take away from. When it comes to today's session. Of course, barring the FMCG pack, that's of course taken the lead today in a very weak and subdued market. We saw FMCG shining bright, 1.5% kind of a gain coming in on the Nifty FMCG index. And good news, right, in terms of earnings, when you look at the updates coming in from some of these companies. We'll be, of course, talking about that in just a bit. But, of course, in terms of the broader end of the markets, they were underperforming today. That was not the case in the last few sessions. But today, that's also been a departure from the recent trends that we've seen. The Nifty mid-cap index was down somewhere around 0.3%. Same goes for the small-cap index. The breadth, skewed in terms of, in favor of laggards, so to say, 2:3. That was the advance decline ratio on the NSE. 1,038 advances to 1,685 declines. Even the India VIX index, deserves mention, saw some bit of an uptick, 2% uptick, but nothing really to worry about on that front, given the fact that it remains around the 12.5 mark or so. But lots of movers, individual movers, that has been the trend, right? Even when markets have been subdued, we've seen some of the stocks emerge as high flyers. Some of them have seen extreme selling pressure as well. So it's an individual stock kind of a market. For the Nifty 500, just want to take you through some of the gainers and laggards. Jai Prakash Power, that was the top gainer on the Nifty 500 index, 18% gain on that stock. GCPL, of course, we'll be talking about that, good 6% gain coming in there. Ratan India, Alkyl Amines, Metropolis, Dabur, these are some of the other movers. On the flip side, Deepak Fertilizer, that was the top laggard on the Nifty 500 index. Endurance, Chennai Petro, Asahi India and Indus Towers, these are some of the movers on the downside. But, of course, two big triggers this week, as you mentioned as well. We are racing against time to, seal that mini deal with US. Of course, that is something that all eyes are trained on. But aside of that, you have earnings season kicking off with TCS reporting numbers later this week, which is why I think we saw some bit of weakness in the IT pack. There is a fair bit of caution when it comes to IT stocks, especially with the likes of Tech Mahindra already being downgraded by a few brokerages, right, on the back of valuation concerns. So yes, TCS, IT pack will be in focus, and you also have the US FOMC minutes that will come out later on Wednesday night. So some clues expected as to what the Fed is expected to do going forward. But Lovisha, top movers on the index level?
Yeah, let's take you through some of that. Like Nandita has mentioned that we are ticking against time when it comes to the July 9 tariff deadline. But yeah, some of the top gainers and losers on the Nifty 50, the FMCG stocks continue to take the shine, and we can see some of the gainers on the Nifty 50 list. For instance, you have your HUL with about 3% gains, Nestle, Tata Consumer Products doing well with about 1% gains, and you see the likes of ITC also doing well with about 0.8% gain that is coming in for those those stocks. Other than that, we can see Geo Financial with about nearly 1% gains coming in. Eicher Motors also doing well with about 1% gain. On the other hand, if you look at from the top losing end on the Nifty 50, Bharat Electronics seeing a cut of about 2% or so. We did see Axis Capital giving a reduced rating on the counter given the sharp valuations, and the stock has been trading on a lifetime highs. That is why the stock is not doing well in today's trading session. Tech Mahindra, like Nandita was talking about, some of the IT stocks have not been doing well given that we have some large cap IT numbers which will be later this week as well, and of course some of the concerns of demand slowdown which is also weighing on the counter. Tech Mahindra not doing well with about 2% cut. ONGC, Ultratech Cement, Eternal also with seeing a cut of about 1% or so. But yes, taking some stocks in focus, we had Jubilant Foodworks that did come out with its Q1 update. The stock did see a downtrend of about 3% or so, but the company did record a good performance in the first quarter. But the turkey business, that is where some of the weakness was seen, and that is why the stock did not do well in today's session. But yes, from a Q1 business perspective, the consolidated revenue that increased by a good 17%, and Domino's India like-for-like growth also grew in double digits. But yes, like I was talking about the Domino's Turkey's business, the like-for-like growth declined by 2% on a year-on-year basis. Now, how the brokerages have responded to it? CLSA has shared an underperform rating on the counter, and they have shared a target price of about 519 rupees per share. And they said that the company's first quarter standalone sales, which increased by 18%, was below their estimates by about 1% or so. And CLSA believes that the investors will be focused on the profitability in its results to judge if any of the high like-for-like sales growth will be translating to better margins. On the other hand, if you look at from another brokerage firm, Morgan Stanley on the other hand has given out an overweight rating on the counter, and they have shared a higher target price which is about 781 rupees per share. Now, if you look at the stock, that stock did not react well today given the weakness in its turkey sales, and the brokerages too seem to believe that the stock is trading at higher valuations at this point of time. So that is why we could see some downtrend and some pressure on the stock which was visible today.
That's true, Lovisha. The stock may be deep in the red, but because you picked this stock now, it's got me hungry, so to say. I can only think of pizzas at Dunkin' Donuts right now. But let's also shift focus to some of the traditional names then when it comes to FMCG, because this entire basket was doing well today. But yes, for Jubilant Foods, the stock has been under pressure. The stock has been facing raw material, high raw material prices in the wake of higher inflation. It has had stiff competition from quick commerce as well, which gave the customers more access to smaller names as well, right? So yes, it has been facing pressure. But you mentioned that otherwise, except for the turkey business, the update has been pretty good. But the street, of course, not focusing in on the positives just yet for Jubilant Food. But I'm talking about the next stock today, Godrej Consumer. That stock saw a very good up move, 6% up move on the back of good update for the first quarter. Not just GCPL, all the others like Darad also came out with first quarter updates, and here as well, there was a decline in the beverages segment, softness in the beverages segment, but the strong performance that is expected in home and personal care is something that took precedence, and the stock was also rewarded by shareholders on the back of good first quarter update. But talking specifically about GCPL, now standalone business is expected to deliver high single-digit value growth, and that will be driven by mid-single-digit volume growth going forward. Volume growth, of course, has been strongly competitive. It has been improving on a sequential basis. Home care, that is expected to deliver double-digit, value growth going forward. Personal care is also expected to grow value in single digits. Standalone EBITDA margins is expected to improve going forward. Even benefits of palm oil moderation, that is expected to kick in from the second half of FY26. If you look at the consolidated revenue, that is seen in double digits going forward on the back of high single digit underlying volume growth. In fact, if you look at the guidance for Godrej Consumer, they have maintained it, and they are expecting to deliver double-digit consolidated EBITDA growth for FY26, and that's something that the street has also taken heart from. But if you look at the overall verdict from brokerages, it is fairly mixed here as well. HSBC is fairly upbeat on the stock. It has a buy rating. Target price is at 1420 rupees, a 19% upside if you compare to Friday's closing price. Today, of course, the stock shot up 6%. India revenue growth, according to HSBC, grew by high single digits. Consolidated revenues grew in double digits. Home care vertical growth was broad-based with double-digit value as well as volume growth. And ex-soaps business, the India business, has been very strong according to HSBC, and they are also expecting margins to pick up in the second half of FY26, and also noted the fact that there has been no change in the guidance from the company. On the other hand, you have CLSA. They are extremely cautious because they have an underperform rating, and the target price is at 1062. That is implying an 11% downside from Friday's close price. Now, they are seeing Q1 update as being slightly below their forecast. They were expecting 10% standalone growth. So that hasn't happened, and that's why they are a little disappointed. They are expecting consolidated rupee revenue growth to be in double digits versus estimate of 11% and broadly in line. But they believe that expectations of mid-teen value growth in FY26 might be a bit too much. You know, that expectation is a bit too high, and that the company may not be able to deliver, which is why they are a little cautious. If you look at the stock performance, last 1 year it's been down 11%. Although in the last 4 months the stock has picked up steam, it has almost rallied 30% or so from in early March. So yes, it has picked up traction. Overall, FMCG universe is expected to do well in the first quarter given the kind of updates we've had. Also remember, when we had the tax cut announcement in the budget, one would have thought that we will see FMCG stocks take off. They did take off for a couple of sessions, but you know, a full-fledged rally didn't really come to play, right? So that's something that street is hoping for, that now that earnings pick up, perhaps we will see FMCG stocks taking the lead here on.
That's right. FMCG stocks, so far everyone was betting on whether or not the urban demand is going to pick up, but now that some signs have been emerging, the street has turned quite bullish on majority of the FMCG counter. But yes, shifting focus from FMCG to Senco Gold, one of the jewelry makers, the stock did hit about 5% upper circuit today. It did cool off and settled with about 4% gains. But yes, today's rally came on the back of a healthy Q1 business update that the company did post. Now, in the update, the company recorded about a double-digit growth in the retail as well as the total revenue, which came due to higher consumer demand during regional festivals and its continued focus on retail footprint expansion. Now, during the quarter itself, the company said that they have launched 9 new showrooms, taking the total count of the showrooms to about 179. And going ahead also, the company also believes that they are on track to meet its annual target of launching 20 new showrooms by the end of FY26. They also plans to launch lifestyle and fashion jewelry brands, which includes the likes of Senes, Gossip and Everlight as well. Now, despite today's good performance, investors haven't really been enthused about the stock so far this year because the stock has plunged over 30% or so. Now, if you look at Senco Gold, the company's growth story on paper is quite great. But when it comes to its poor cash generation over the last 3 financial years, that has kept actually the buying interest away from the investors. And that is why we can see a little bit of a tepid performance that came in so far this year as well.
Sure, and of course, not to forget that we've seen a very sharp rally on gold prices as well, right, which has impacted demand. But now the company is betting on, diamond sales. And they've, in fact, the management was on CNBC TV 18. I was just listening to the interview as well. They've mentioned that if diamond sales continue, they are expecting better margins of 7.2% or thereabouts. And that will be, of course, better than the guidance that they have given. And they've also pointed out that consumers are looking at diamond jewelry once again after the rise in gold prices. In a month or two, in fact, they are hopeful of prices moving up when it comes to diamond, and 20% plus growth could be expected in the diamond jewelry segment as well. So, perhaps this is one segment that could lend support to their growth going forward. And of course, not to forget that they are already confident of achieving their FY26 guidance of 19 to 20% or so. Aside of that, the other stock that's on my list is, of course, one of the capital market plays, right? In fact, it's a Jefferies note that has come out on capital market plays itself. Of course, Of course, we know that last Friday we had this big news of SEBI's interim order on Jane Street banning them from accessing Indian market because of the alleged manipulation that they carried out in the cash market and the option segment as well. So, of course, on that particular issue, Jefferies has come out with a report. We saw capital market plays like Nuvama, BSC, Angel One, all of them getting badgered in trade on Friday. In fact, Nuvama was among the worst hit. It saw 11% cut, 3-month lows. As it is the India partner for Jane Street as well, right? So yes, in this report, Jefferies has pointed out that the SEBI's interim order highlight sharper focus on governance. Of course, this after the SEBI chief has also reiterated and said it in no, I mean, he didn't really mince words when he said that there will be zero tolerance for market manipulation, right? So yes, this interim order does put the limelight on sharper focus on governance, and there could be, according to Jefferies, a knock-on impact on trading volumes, as Jane Street was a major player, right? So of course volumes will be impacted, but of course some kind of partial offset may happen when it comes to this volume drop, given the fact that domestic prop desks could lift volumes. Aside of that, they are saying that one should watch out for the derivatives volumes going forward, especially the index derivatives expiries, on Tuesdays and Thursdays. We'll have to see how volumes pan out on these particular days, because these are the days when we saw volumes spiking and price spikes as well, right? And according to SEBI's interim order, the manipulation was actually taking place on these particular days, the expiry days. It also made an interesting observation when it comes to the options premiums turnover on Friday. They mentioned that it was slightly below 2-month Friday average, but the turnover was still up on a week-on-week basis. So, that's why next week, well, like this week, the expiry days and how the volumes pan out on these days will be crucial to watch. In terms of stocks and the impact on capital market plays like BSC and Nuvama, Jefferies sees limited impact on BSC. Now, for BSC, the derivatives drive 58% of their FY26 revenues. Within this segment, FPIs drive 3 to 4% of the turnover, which is why Jeffrey believes that the contribution from Jane Street would be a smaller subset of that 3 to 4% turnover, which is around 1% or thereabouts. Hence, the impact on BSC's earnings should be limited to 100 basis points, and for EPS, it should be somewhere around 50 to 60 basis points. This is according to Jefferies. For Nuvama, the impact will be a little higher. It says that 15 to 20% of asset services and institutional equities revenues come from Jane Street. So it expects an impact of around 5 to 6% on overall revenues and 7 to 8% on earnings. Remember Friday, of course, there was such a big sell-off on these shares because Street was expecting a bigger hit on Nuvama. Some say 18 to 20% kind of earnings hit because of this Jane Street issue, because of course Nuvama is the Indian trading partner of Jane Street. But this Jefferies note allays some concerns on that front. Yes, the earnings hit will be bigger, but it will be limited to somewhere around 7 to 8%, which is why I think we saw some bit of a uptick in share prices of Nuvama as well today. But going forward, the key monitorables according to Jefferies would be for Nuvama, the ability to compensate the impact through newer client additions on the asset services side, pick up in investment banking deal flow, and pick up in institutional equities volume. So these are some of the monitorables for Nuvama. So all in all, of course, volumes will be hit, but how much of a hit would that be, given the fact that Indian prop desks may be able to make up for it. But yes, lots to really watch out for on the Jane Street issue, because the SEBI order is still an interim one. The probe is being widened to other indices aside of Nifty and Nifty Bank, Fin Nifty, Sensex, Nifty IT, a lot of these other indices. So yes, we'll have to wait and watch as to how things really pan out. But Jefferies note kind of allays fears in terms of how the stocks or how the earnings will be impacted when it comes to these particular stocks. Lovisha.
That's right. The vacuum that has been left after the Jane Street's market manipulation, that is something that the derivatives market will be watching out for, whether there is any other domestic liquidity provider that can actually not cause any further upswings in the market as well. But yes, we also have a Moneycontrol exclusive on this front, where they are trying to, where sources have learnt that SEBI could be also looking out for whether or not Jane Street Group has violated some position limits on which is prescribed for the FNO options. So yes, this is something which is a developing story, and we'll be watching out more for that. But yes, markets continue to be choppy today as well. Some sentiment, of course, it's in search of triggers at this point of time, given that we have the Q1 earnings, which will be later in this week as well. And of course, like Nandita and I were talking about the US-India trade deal, that is also one of the key monitorable. But with that, we have come to an end of this edition of Closing Bell. It's a wrap from Nandita and me. Thank you for watching.